Good morning. This is Dr. Vineet Chauhan. Today we will be discussing the Income Tax Act and its introduction. The subject is having a code BM282 and that is in the course of 4th semester BBA. Now, as we start first about the income tax, I have pointed out some of the topics which we will cover during this session, which includes the introduction, the residential status, the tax rates, thereafter income from salary. The income from all the 5 heads includes income from salary, income from house property, income from business and profession, income from capital gain, and income from other sources. Thereafter we will check it out, clubbing of income, and finally assessment of individual. Later on we will discuss about the set off and carry forward of losses, deductions from gross total income, agriculture income and the tax calculation over the agriculture income, advance tax, the assessment or procedure of the taxation, e-filing of return, that how we file in the modern time, then some other tax, if we will have the time, we will also discuss these taxes later on. Now we start today with the introduction. As we know that the Income Tax Act was introduced in India in 1860 by the and later on it was discontinued for a few years, and the basic motto of Indian Income Tax Act was that the Britishers want to collect the tax from the Indians, that is the major income from of their government, and the reason for implementing the tax is to recover the losses which they have spent during the 1850s freedom fight from the Indian Kingdom. So this act, the Income Tax Act, was implemented by refining in various phases, and the tax system, the Indian income tax system was introduced, that is in 1939, and the current Income Tax Act thereafter, which is Income Tax Act 1961, was implemented from 1st April 1962. This act was operated from the assessment year 1962 and 63, from where the income is being taxed. Now we check it out, some of the points regarding the Income Tax Act. These points includes the calculation, and the major part of this is called as assessment. Assessment is the procedure by which we calculate the income from a person, and later on with the help of that calculated income, the tax is being calculated as per the residential status of the person. For the purpose of the tax rate is being given and is given by the government as per the Finance Act, which is presented before the Parliament by the Finance Minister each year. So the tax will be calculated on the basis of the current Finance Act. Charge of tax. The income tax is charged each year as per the rates given in the Finance Act, and that is charged for the current period that starts from 1st April 2014 to 31st March 2015, which is also called as the previous year. The total income of the previous year, that is 1st April 2014 to 31st March 2015, is calculated, and that income will be subject to tax for the purpose of current assessment year. The current assessment year is from 1st April 2015 to 31st March 2016. That we also check it out later on. But when we check out the important definition, the definition includes first definition, that is person. Persons, by the nature we believe that persons means the individual person, but in case of subject to income tax calculation, the various persons are included in the definition, which includes as an individual or natural person, then Hindu undivided family, which is again a different separate entity from the person. This entity is created by the group of the people or the person of one family. The person of one family can be assessed as Hindu undivided family because the Hindu undivided family may be owned the family business. Thereafter, format of company, format of firm, association of person, this is the partnership firm, association of person which will be making for the purpose of a common objective or the body of individual, then the local authority and any other type of artificial judicial person on which the court can implement a law, that will be included in the definition of the person. So as per Income Tax Act, the tax is being levied on the person. Now we will check it out, the definition of assessment year and the previous year. The year which is which ends on 31st March of the current year, or the year for which we calculate the income which is subject to the tax, is called the previous year. For the current period, the previous year is 1st April 2000, for the current period, the assessment year is 1st April 2015 to 31st March 2016, that is the assessment year, and the previous year is the 1st April 2014 to 31st March 2015. The previous year's income is subject to the tax in the assessment year. So the assessment year means the current period in which we calculate the tax on previous year's income. So we calculate the tax for the period of 1st April 2014-15 to 31st March 2015, and that income which is earned in that period will be taxed in assessment year from 1st April to 31st March. As we have already seen that there are various persons which is included in the definition of the assessee or the individual or the person. All the persons are liable to pay the tax on their income of the previous year, and the person from whom any tax is due, that may be for the purpose of interest or penalty or the amount of tax, but that person will be called as assessee. So the time when we identified the residential status of a person, that will be called as residential status of an individual. When the individual has earned some amount as an income which is subject to tax, then the individual will turn to be an assessee. So assessee includes all the persons which we have already checked out as per the section 231. Now we check out the residential status of the person. The tax is being calculated on the basis of the residential status of the person. There will be 3 residential status which is available for an individual or for a person. But for the other entities, there may be only 2 residential status. So the first we will be checking it out, the status. Number 1 is the resident or R. Resident means the person who is living in the particular country. Non-ordinarily resident, the person which will be following some rules but not the all, will be called as non-ordinarily resident. And third is non-resident, the person who is living outside the country but not working in or not earning his whole income from the country is called as non-resident. Now the rules are also there. As per the rules, we will identify the status of the residence for a person. First, we check out the residential status of an individual. The residential status is based upon two different type of conditions: basic condition and additional condition. If a person satisfy, there are two basic conditions and two additional conditions. The two basic conditions, out of which if any one is being fulfilled, we say that basic conditions are fulfilled. And if a person will fulfill one basic condition and both the additional conditions, he will be called as resident. If a person will satisfy the basic condition but will not satisfy either of the additional condition, that will be called as non-ordinarily resident. And if a person will not satisfy the basic conditions, will be called as the non-resident. And checking it out of additional condition is not compulsory for the non-resident, since the basic condition is not being fulfilled. Now we check out what will be the conditions. The two basic conditions are that a person should be in India for 182 days or more in the previous year. If that is there for 182 days, we believe that first basic condition is fulfilled and we move to the additional conditions. We will not check out the second one. But if the first condition was not fulfilled by him, then we check out the second condition, but there is a word or which is written. That means either this one, first one, or the second one should be fulfilled. So the second basic condition is that he must be in India for a period of 60 days in the last year only, in place of 182 only 60 days, but including 365 days or more in the 4 previous year or 4 preceding previous year. So if he was in India for 60 days in the last year and 365 days in the 4 preceding to the previous years, he will be called as that the person has fulfilled the basic condition. So either the one will be fulfilled, then we believe that it will be the resident. Now additional conditions. First additional condition, that he must be the resident of India for any 2 years out of 10 previous preceding years, and he must be in India for 730 days in 7 preceding years. Now these two additional conditions both are compulsory, which means that the 2 additional and 1 basic conditions, if it is fulfilled, we believe that assessee is the resident. If only basic condition is fulfilled, no additional conditions are fulfilled, then we say that the assessee will be non-ordinarily resident. And if the basic condition, both of them are not being fulfilled, the residential status of the assessee will be non-resident in India. As per the residential status, the tax is being levied, so that is why the residential status is important. The another thing which is next to the residential status, that is the residential status of Hindu undivided family. As per the individual, the residential status of Hindu undivided family is also divided into the 3 parts: resident, non-resident and non-ordinarily resident. Now in case of Hindu undivided family, the residential status is based upon the karta or the manager of the undivided family and the control and management of the affairs. If it is situated fully in India, we will say that the Hindu undivided family is resident in India. In case if the control or the management of the affairs of HUF is situated fully from outside India, then it will be called as non-resident. And in case the HUF's Karta is non-ordinarily resident in India, the residential status will be non-ordinarily resident for HUF2. So, based upon the residential status of Karta or the manager, the residential status of HUF is determined. If we check out the residential status of the other entities, for other entities there will be only two type of residential status, that will be resident and non-resident. And as per the section 6(3) of Indian Companies Act, all the companies which are registered in India, that will be called as resident company. And if the control or management of the company for which is registered under any of the act in outside India, then the control is if the control is from India, it will also be called as Indian company or the resident company. Here it is important to mention that the control of management means the control or the board of management where the board meeting is to be held. Suppose the board meeting is held in India and all the meetings are held in India, then it will be called as the Indian company or resident company. While if the board meetings are held outside India and the company is registered in any of the act outside India, that will be called as non-resident company. Similar to the company, the association of person is also having the same point regarding to the control and management. If their control is from India, then it will be called as Indian resident. If it is from outside India, they will be called as non-resident in India. In case of the partly management from India and partly from outside India, the company or association of person will also be treated as resident as for the purpose of calculating tax. So, if the control and management is from India or partly from India, it will be the resident, otherwise it is non-resident. Now if we talk about the residential status, it should be mentioned that why residential status is important. The residential status is important because of the incidence of tax. If an assessee is the resident in India, certainly they have to pay tax on the total income which is being earned by them in India as well as in foreign. So, resident means the person's total income will be taxed in India. Non-ordinary resident means the income from income which is earned from India and the income from which is earned from the company who is managed from India. They have to pay the tax over that income. In case of non-resident, only the income which they have earned in India, that on that income they have to pay the taxes. So, on the basis of income earned and income received, I have made the table so that we will be able to identify that when the tax is being payable. The tax incident here, that is written for all the three different types of entities or individuals: resident, non-ordinary resident and non-resident. So, as per the residential status, we will check out that whether they have to pay the tax or not. So, we start with the 2 points which is important: income which is earned or which is received. If any of the thing is in India, we will treat it as income from India and as it will be taxed. So if income is received in India or received by anyone or on behalf of the Indian person, that will be taxed for all the persons. So if a person is resident or non-ordinary resident or non-resident, the person has to pay tax because income is received in India. If income is deemed to be received or income is earned from India, then also all the residential status of the SSC, whether SSC is resident, non-ordinary resident or non-resident, he has to pay the tax. If income is occurring or arising from India, then also all of them have to pay the tax. If the income is deemed to accrue or deemed to arise in India, then also they all have to pay the tax. When the income which arise outside India, if income is earned from outside India, then also then only the resident will pay the tax. Rest too will not be paying the taxes because that is earned and received, both the things is outside India. Before we move to tax to the tax rates, there is one more point which is not included here. That is that income which accrued or arise and received, both the things is outside India, but the business is being controlled from India. In that case, resident and non-ordinary resident both will be subject to tax, means both will pay the tax, while non-resident will not be charged tax on this basis. Now we check out the rates of taxes. So the rate of taxes for the individual or HUF will be as under: income which is up to 2,50,000 rupees for a simple resident, income up to 2,50,000 rupees, the rate is nil, so he won't have to pay the tax. Next, 2,50,000 means 250 to 5 lakh, he has to pay 10%. On up to next 5 lakh rupees means 5 lakh plus 5 up to 10 lakh rupees, he has to pay 20%, and income about 10 lakh is being paid 30% for the purpose of the tax. So this is the tax rate for an individual. For a senior citizen or a person who has completed 60 years in the previous year or before the previous year, for him up to 3 lakh rupees the rate of tax is nil. After 3 lakh up to 5 lakh means next 2 lakh the rate of tax is 10%. Thereafter for next 5 lakh it is same, and above 10 lakh also it is same. So the person who has completed 60 years in the last year is getting the benefit of 50,000 rupees extra. If we talk about the super senior citizen who turns to be 80 years or who is more than 80 years in the last year, is called as super senior citizen. For a super senior citizen, up to 5 lakh rupees tax rate is nil, and thereafter 5 lakh, next 5 lakh is 20%, and next more than 10 lakh rupees it is 30%. So the rate of tax for an individual is calculated on this basis. Next we check out the rate of tax for other income, like the income which is prescribed by the Income Tax Act. So according to the tax prescribed for those income, the tax is being levied or charged. Casual income means the income which is earned by the SSC due to the chance only, which is only based upon the luck. It is a non-recurring income and normally earned due to the chance, like lottery, like crossword puzzle, card game, or any other game in any other club, where the chances of winning is equal for all the participants. So if that casual income is earned by the SSC, it is directly charged or directly subject to 30% of the tax. So on that income directly 30% will be charged. If the SSC has earned the income due to short-term capital gain, means the capital assets is being sold, and on the capital assets which is owned by the assessee for less than 3 years, then it will be called as short-term capital gain. On short-term capital gain, direct 15% rate of tax will be levied and will be charged 15% tax. For long-term capital gain, means if the assessee has acquired the assets and kept the assets for more than 3 years, assets will convert it into long-term assets and the gain of selling will be called as long-term capital gain. If it is subject to without indexing, the direct tax rate is 10%. If it is with indexing, the tax rate is 20%. Normally, the assessee will check it out that which rate is beneficial for the assessee and accordingly that will be subject to the tax. For partnership firm, rate of tax is straightforward 30 rupees. There is no other block or there is no other exemptions. Directly whatever is being earned, 30% will be the rate of tax for partnership firm. For a domestic company, the rate of tax is 30%. Straightforward rate, and they are also subject to minimum alternative tax of 18.5% on their book value. Similarly, the foreign company, the tax rate is 40% direct and the minimum alternative tax on book value is also 18.5%. Sometimes the company want to save the tax and they will show the depreciation and other items which is not being paid in cash to any of the shareholders or the outsider party. Then in that case, to calculate the actual level of the tax is calculated on its book profit and minimum alternative tax is being payable. Finally, at the end of the year, if the tax is payable at the rate of minimum alternative tax, which is 18.5%, is compared with the tax rate. If assessee has paid more tax as per MAT, then in the next year they will be getting credit. While if they have paid less, they have to pay 30% straightforward on the basis of their income. The local authority or the local persons, they also have to pay the tax. The local authority have to pay 30% of the tax on their income. Thereafter, cooperative society is also having the similar type of things. So up to 10,000 they have to pay 10%, 10 to 20,000 20%, above 20,000 they have to pay 30% of the tax. Except these tax rates and the tax rate shown in the previous slide, all the assessee have to face the three different type of taxes like education cess, which is the first one. It is payable at the rate of 2% on the above tax, plus the secondary or higher education cess at the rate of 1% of the previously calculated tax, plus the surcharge is also payable. If an individual has earned more than 1 crore rupees, he has to pay 10% surcharge. If a domestic company has earned from 1 to 10 crore, it has to pay 5% of the surcharge. If the company has earned over 10 crore rupees, they have to pay 10% surcharge. For the foreign company, if the company has earned 1 to 10 crore, they have to pay 3%, and more than 10 crore, they have to pay 5% of the tax.